So the next thing I do want to talk about is interest rates and what's happening because this is a very, very popular topic. People want to know how high rates are going to go, how long are they going to stay high, and how is this going to affect mortgage rates? Do I go variable or do I go fixed? And I'm going to go to a website, and this can be found at tradingeconomics.com. We're going to be tracking interest rates from about the mid 90s until now. So that's almost 30 years. And let's look at a few trends. So, the most obvious trend that you can see is there's a clear downtrend. So, let's look at the interest rate peak around 2000 until now. There's a clear downtrend. We know rates are going lower over time. Now, let's look at the previous interest rate hike cycles and let's take a look at the relative increase in interest rates and let's look at the absolute increase in interest rates. So, in the mid to late 90s, the interest rates were hiked, and that was from about 3% up until almost 6%. And remember that what I'm talking about right now is the overnight interest rate in Canada. And remember that the prime rate follows the overnight rate, and the variable rate mortgage also follows the overnight rate and the prime rate. So all these things move in tandem. So from the late 1990s, we had an interest rate hike from 3% to about 6%, so a doubling. And then in the mid 2000s, until just before the great financial crisis, we had an increase in the overnight rate from 2% to just above 4%, so a doubling. And then more recently, in mid 2017 up until end of 2018, early 2019, we had a hike in the overnight rate from 0.5% all the way to 1.75%. So an absolute increase of 1.25% and a relative tripling. So that begs the question, what's going to happen now? We can look at it from a relative perspective and we can also look at it from an absolute perspective. So, from a relative perspective, we are going to blow past all previous rate hike cycles. We've already gone from an overnight rate of 0.25%, which it was in the pandemic, to 1%. And that's where the overnight rate currently sits. So we've already quadrupled. So we're going to blow past everything on a relative basis. But on an absolute basis, how high can rates go? Well, let's examine the previous interest rate hike cycles. So in the late 90s, we went up about 3%. In the mid to late 2000s, we went up about 2 to 2.25%. And then more recently in 2017, 2018, we went up 1.25%. So if you take an average of all those, you're looking at maybe a little more than 2%. So that could take the overnight rate up to about 2.5%, maybe a little bit more. So if the overnight rate goes to 2.5%, then we've got the prime rate, which currently sits at 3.2%, going up to 4.7%. And so that makes people think, well, what does that mean for the variable rate mortgage? Well, it's obviously going to go up. The other thing that the astute observer will realize here, if you go back and look here, one will realize that these peaks in interest rates, so once the interest rates are hiked, it reaches a peak. These peaks are only around for a short amount of time. You look at the late 90s and 2000, this peak lasted maybe for about 3 years. You go to the mid 2000s until the great financial crisis, this peak lasted for no more than 2 years. And more recently, in 2018, 2019, obviously COVID was a bit of a unique scenario, a black swan event. The peak here lasted for less than 2 years. So we know that interest rates rise, but then they stay at their peaks for 2 years, give or take. So people who are contemplating what to do with their mortgage, they know that the variable rate mortgages are going to go up, but it's only going to stay up for a finite amount of time. It eventually will come down. So something to keep in mind. Now, in terms of the fixed rate mortgage, I will share one more screen with you guys. And remember, the fixed rate mortgages, in fact, follow the 5-year Canada bond yields. So if I go to marketwatch.com, this is currently where the Canada 5-year government bond yield sits today, 2.841%. And if we go and track this over 3 years, we can see the drastic increase that has taken place since the pandemic. And for people who are locking in a fixed rate mortgage in 2020 and in January 2021, they were locking in rates of 1.4%, 1.5%, 1.6%. And that's because at the time, the yield on the Canada 5-year government bond was 0.4% or less. So usually the differential between the Canada 5-year government bond yield and a 5-year fixed rate mortgage is between 1 and 1.5%. So that means that now fixed rate mortgages are creeping into the 4%. That's significantly, significantly higher. And what's going to happen to the 5-year government bond yield? It's really anyone's best guess. But remember that the Bank of Canada is now not buying any more government bonds. So when demand for those bonds goes down, their price goes down and their yield goes up. So if anyone was to predict, this bond yield could continue to go up, thereby driving up fixed rate mortgages even further. So it's something to keep in mind. The next thing people are wondering is, well, what's going to happen to the housing market? Is it going to soften? How much is it going to soften? I think it's safe to say we are seeing some softening. But let's go back to the last interest rate hike cycle that started in mid 2017, and let's examine what happened to rates and what happened to a few other items and what that did to housing prices. So essentially, in April 2017, Ontario agreed to bring in the foreign buyers tax. And then in October 2017, they introduced a higher stress test for mortgages. All at the same time, you had interest rates going up, you had this triple whammy effect, and then the housing market certainly did soften. So in the GTA, we had housing prices decline 15 to 20%, maybe a little bit higher in areas like Richmond Hill, where you had more foreign buyers typically. So, what's going to happen this time around? Well, we certainly have interest rates that are going up. They're going up even faster. The new federal budget that came out said no foreign buyers real estate for 2 years, double whammy. And then the stress test, what's going to happen there? Well, the stress test for the mortgage is basically going to be the higher of 5.25% or 2% more than what your borrower offers you. So if fixed rate mortgages are creeping into the 4% plus range, you're going to be stressed at 6% or more. So the stress test for many people, if they go fixed, is going to go up. So you have a potential triple whammy effect. It's anyone's best guess, but safe to say the housing market could soften.